The crypto world was rocked in February 2025 when Bitcoin crashed 17.2% in just a month, its worst performance since June 2022. But what caused the sudden freefall? It all started with a massive $3.3 billion outflow from Bitcoin ETFs, the largest withdrawal since these funds were introduced. Institutional investors, the same ones who once fueled Bitcoin's meteoric rise, were suddenly pulling their money out at record speed. This wasn't just a routine dip, it signaled something much bigger. The panic spread fast. As Bitcoin's price tumbled, Ethereum, Solana, and other top altcoins followed, losing billions in market value overnight. Crypto Twitter exploded with speculation. Was this just another correction, or were we witnessing the start of a long-term bear market? Adding to the fear was the weakening of Bitcoin's narrative as a hedge against inflation. For years, investors viewed BTC as digital gold, an asset that could protect against economic instability. But in early 2025, something changed. While Bitcoin was crashing, gold was soaring. In just a few months, gold had gained nearly 8%, attracting billions from risk-averse investors who saw it as the safer bet. At the same time, retail traders who once drove crypto's wild rallies were growing skeptical. The hype of 2021 to 2022 was long gone. NFTs had collapsed, meme coins were struggling, and even AI-related tokens weren't seeing the explosive growth many expected. The question on everyone's mind was clear: was crypto's best era behind us? But the real shock came when analysts started looking deeper. Some believed this wasn't just about price action or market cycles. They suspected institutional investors knew something the public didn't. What if this sell-off was just the beginning of a much bigger shift? And as it turns out, the biggest players in the market were making moves behind the scenes that no one saw coming. If you thought retail investors were behind Bitcoin's 17.2% crash, think again. The real players pulling the strings? Institutional investors, the so-called faster money of the market. Unlike long-term Bitcoin believers who hold through every dip, institutions treat crypto like any other high-risk, high-reward asset. They don't buy Bitcoin because they believe in decentralization or blockchain's future. They buy it when it's profitable and dump it the moment risk outweighs reward. That's exactly what happened in February 2025 when institutional investors began cashing out billions from Bitcoin ETFs. These funds, which were once celebrated as the bridge between traditional finance and crypto, turned into a ticking time bomb. The moment institutions sensed trouble, they exited fast, triggering a wave of panic that sent Bitcoin tumbling. But why now? The signs were there: rising interest rates, shifting regulations, and growing uncertainty in global markets. For hedge funds and asset managers, Bitcoin was no longer the must-have asset it was in 2021. Instead, they started looking elsewhere. Some moved back into gold, while others parked their cash in bonds and traditional markets. Retail traders were left stunned. Just a year ago, many believed institutional adoption would be the key to Bitcoin's long-term success. But the reality was far more brutal. Institutions weren't here to stay. They came for quick profits, and when the time was right, they left just as fast. This mass exodus didn't just hit Bitcoin. Ethereum, Solana, and other top altcoins felt the pressure too, losing billions in market cap. Liquidity dried up, trading volume shrank, and suddenly, the market's confidence was shattered. So, was this a strategic pullback, or did institutions know something the public didn't? Some experts believed they were reacting to regulatory shifts that could change crypto forever. And just when the market needed stability the most, the US government made a shocking move. Just when the crypto market was already on shaky ground, another shocking twist sent investors scrambling. The SEC suddenly backed off its biggest lawsuits against crypto giants like Binance and Coinbase. For years, the US government had been cracking down hard on crypto. The SEC accused Binance of violating securities laws, sued Coinbase for operating as an unregistered exchange, and threatened to delist major tokens. Regulators painted crypto as a wild west that needed strict oversight. But in early 2025, everything changed. Under the new Trump administration, the SEC took a completely different stance. Instead of tightening restrictions, they suddenly dropped key lawsuits that once seemed like a death sentence for crypto exchanges. Even more surprising, officials started pushing for a friendlier approach, suggesting that crypto could be an important part of America's financial future. Why the sudden shift? Some believe it was a strategic move to bring crypto businesses back to the US. For years, regulatory uncertainty had pushed major players offshore, with companies fleeing to Dubai, Singapore, and Europe. Now, the US government seemed to be signaling that it wanted crypto back on American soil. But not everyone was convinced this was good news. Some experts saw this as political theater, an attempt to win over younger, tech-savvy voters ahead of the 2026 midterms. Others warned that this sudden shift in policy could create even more instability as companies and investors scrambled to adjust. The market's reaction? Mixed. At first, Bitcoin and Ethereum saw a small price spike, a sign that some traders saw this as a bullish shift. But institutional investors weren't rushing back in just yet. They wanted clarity. Would the SEC's softer stance last, or was this just a temporary pause before another crackdown? One thing was clear: regulation was no longer the biggest threat to crypto. For years, meme coins were seen as the wild card of the crypto market, risky, unpredictable, but sometimes explosively profitable. In 2024, they dominated the scene, with tokens like Dogecoin, Shiba Inu, and a wave of new, next-gen meme coins attracting millions in trading volume. Fueled by celebrity endorsements, viral social media campaigns, and influencer hype, these coins created overnight millionaires, but also led to devastating losses. At first, it seemed like meme coins were unstoppable. Every week, new projects launched, promising the next 100x, and investors piled in with hopes of striking gold. But by early 2025, the cycle started to fall apart. The once driving meme coin market was now littered with failed projects, abandoned tokens, and rug pulls. Retail investors, who had been the driving force behind these parabolic surges, began losing trust. The real issue? Meme coin speculation wasn't just hurting those who bought in, it was damaging the credibility of the entire crypto market. Billion-dollar crashes in meme coins drained liquidity from legitimate projects. Even worse, institutional investors who once considered Bitcoin and Ethereum as serious assets started pulling out, seeing the entire market as nothing more than a speculative bubble. This collapse was a wake-up call. Crypto was supposed to be about decentralization, innovation, and financial freedom, but to outsiders, it was looking more like a high-stakes casino. Traders were no longer investing in solid projects, they were chasing the next viral meme. Some believed this was just a necessary correction, a way for the market to filter out weak projects and reset. But others feared irreversible damage had been done. If crypto couldn't shake its reputation as a speculative playground, would mainstream adoption ever happen? And just when the market needed stability the most, another unexpected threat emerged, and this time, it came from outside the crypto space entirely.
Do you want to learn how to get familiar with crypto? You've heard about them before, but you've never considered having a real approach to them. Give me 30 seconds to convince you. Deposit $100 and get up to 50 USD in rewards. Verify your account, deposit, and start trading to maximize your bonuses. Are you still insecure? At Bybit, the more you deposit, the more you earn. With your first deposit and trade of just $500, you can get an instant $50 bonus. And if after all this I still haven't convinced you, I suggest you try the app. Because Bybit is not just an application, but a reality.
For years, Bitcoin was seen as the future of finance, a revolutionary asset that could compete with gold as the ultimate hedge against inflation and economic uncertainty. But in 2025, that narrative was starting to fall apart. As the global economy teetered on the edge of recession, investors weren't pouring into Bitcoin like they had in previous years. Instead, they were moving back into gold. While Bitcoin dropped nearly 24% from its peak, gold surged, hitting new all-time highs. Why? Because when uncertainty rises, investors look for stability, and gold has a 5,000-year history of holding value. The shift wasn't just among retail traders. Institutional investors, hedge funds, and even central banks started reducing their Bitcoin exposure in favor of gold. Even Michael Saylor's MicroStrategy, one of the biggest corporate holders of Bitcoin, quietly slowed its accumulation as concerns about crypto's long-term stability grew. One of the biggest issues? Bitcoin's volatility. Unlike gold, which moves slowly over time, Bitcoin's price swings were still extreme. A single piece of negative news, whether it was a government regulation, a whale sell-off, or an exchange scandal, could send prices crashing. Investors who once viewed Bitcoin as a digital store of value started questioning if it could truly compete with gold in times of crisis. But it wasn't just price action causing concerns. Geopolitical instability was making gold more attractive than ever. As tensions between major world powers escalated, central banks were stockpiling gold at record levels, a clear signal that governments still trusted gold over digital assets when the stakes were high. Was this the end of Bitcoin's status as the new gold? Or was this just a temporary setback before crypto made its next big comeback? Some analysts argued that Bitcoin was still too young to replace gold and needed more time to gain institutional trust. Others believed that Bitcoin would never truly replace gold, but would instead exist as a separate, high-risk asset class. But before anyone could declare Bitcoin's fate, something was about to shake up the entire market. The 2025 Bitcoin halving was just around the corner, and it could change everything. While crypto was struggling to regain its footing, a new competitor was quietly taking over: AI-driven financial systems and tokenized assets. In early 2025, major banks and investment firms started integrating AI-powered trading bots that could analyze markets in real time, execute trades at lightning speed, and adapt to trends far better than human investors. These AI systems weren't just trading Bitcoin and Ethereum, they were shifting attention to more stable, regulated assets. At the same time, the rise of tokenized real-world assets, RWAs, gave investors a safer alternative. Governments and institutions started launching blockchain-based versions of stocks, real estate, and even gold, offering the security of traditional finance with the efficiency of crypto. Unlike meme coins and speculative altcoins, these tokenized assets were backed by real-world value, and they started attracting billions in liquidity. For the first time, crypto wasn't just competing with traditional finance, it was losing to it. Investors who once saw Bitcoin as a revolutionary asset were now looking at AI-driven funds and tokenized securities as smarter, safer bets. Was this the beginning of crypto's decline? Or could blockchain innovation evolve fast enough to stay relevant? The answer might depend on one final factor: the upcoming Bitcoin halving. While crypto was struggling, another asset was quietly outperforming it: gold. In early 2025, gold surged nearly 8%, while Bitcoin collapsed 24% from its peak of $109,000. Investors who once saw Bitcoin as the ultimate digital gold were now shifting their money into the real thing. But why? The answer was simple: uncertainty. With global tensions rising, economic instability, and the crypto market's extreme volatility, big money investors weren't willing to take risks. Gold has a 5,000-year track record of holding value. Bitcoin, on the other hand, was proving to be too unpredictable. Even longtime Bitcoin supporters started questioning if the store of value narrative still held up. If Bitcoin was truly digital gold, why was it crashing while real gold was thriving? Had institutional investors decided that Bitcoin was just another high-risk asset instead of a safe haven? The debate wasn't just about price action, it was about trust. Bitcoin's long-term success depends on belief. If investors start seeing it as just another speculative asset, rather than a hedge against inflation, its future could be at risk. But was this the end of Bitcoin's dominance? Or was this just a temporary shift before crypto made its next big comeback? The answer might lie in the next wave of blockchain innovation. With everything happening in 2025, the Bitcoin crash, ETF outflows, regulatory shifts, meme coin collapse, and the rise of gold, many are asking the big question: is crypto's best era over? Right now, the market is at a crossroads. On one hand, the Bitcoin halving, AI-driven innovation, and asset tokenization could fuel a new wave of adoption. If institutional investors re-enter the space and regulations become clearer, we could see another explosive bull run, one that takes Bitcoin and the entire market to new highs. But on the other hand, there are major risks that can't be ignored. Institutional investors have shown they're willing to exit the market fast, meme coin speculation has hurt crypto's credibility, and rising global uncertainty is pushing traders toward traditional assets like gold. If Bitcoin fails to reclaim its status as a store of value, we could see an extended crypto winter, one that lasts longer than anyone expects. So, what happens next? The reality is, crypto isn't going anywhere. It will continue to evolve, with new technologies, regulations, and market trends shaping its future. Whether we're at the start of another legendary bull run or the beginning of a prolonged downturn, one thing is clear: the crypto market never stays quiet for long. And if history has taught us anything, it's that the biggest opportunities come when everyone else thinks it's over.
If you haven't already done so, visit our website. You will find the link in the description.